price has been suppressed for so long, and then you get it. So look at it this way. I kind of look at the why more than the what, right? The what is, yes, silver's been suppressed, but why? Why do eight Western banks maintained the largest concentrated short position in the history of 1,000+ commodities traded, the largest ever on the exchange? Why? Why would they have this massive short position in silver? Because it's worth more than the dollar value or the dollars used to purchase it would imply. And for many reasons, whether it's a military industrial complex or not, the point is I'm getting at is that they've exerted an awful lot of effort to keep the price of silver, the lid upon it. And I've said for years, the last several years, the countries around the world have become sophisticated and coordinated and wealthy and motivated.
Silver has just done something Wall Street never expected. As December 2025 comes to a close, the global silver price has smashed through $59 an ounce, its strongest performance in modern history. Gold is holding near record highs above $4,000, powered by a weakening dollar, stubborn inflation, and growing expectations of Federal Reserve rate cuts. But this surge isn't just another market bounce. It's a sign that something much deeper is happening beneath the financial system. For the first time in decades, physical demand is overwhelming the paper market. Industrial giants are securing long-term silver supply directly from refiners. Comex registered inventories have thinned to multi-year lows. Sovereign stockpiling and metals diversification strategies are accelerating. And institutional traders are watching the same pressure points tighten week after week. As Andy Schectman has long warned, gold and silver are not merely investments. They're anchors of stability when the monetary world becomes overstretched. And right now, all the signals are flashing at once: shrinking supply, rising demand, monetary easing ahead, and a global shift toward hard assets. Tonight, we break down why this surge is different, what the latest December data confirms, and what every serious silver and gold investor needs to understand now.
And they understand that the key to this, the glitch in the system, is the delivery mechanism. It's kind of like the first Star Wars, where there was that one little hole in the Death Star.
Yeah.
No one thought about it. Well, no one thought that the delivery mechanism would be the death of the system. If you don't allow delivery, you don't have a futures market. So they did it, and it never was exploited until now. And the ability to naked short something when you can stand for delivery, and the entities taking the other side are as wealthy and sophisticated as you are, you got a problem. These countries weren't when these exchanges were founded, and through all the way up till recently, these countries had no desire to challenge the West at all. And this is how you beat them, using their own markets and their own rules against them. And you see one of these banks fail to deliver, well, that will have a reverberation through the entire ecosystem, because these banks have their fingers in every pie, not just the metals pie. And it's a scary thing. You could also see one of the banks that have been shorting it forever break ranks and say, look, we can't do this anymore. We're out. Cover their own interests, and then the whole thing starts to spiral. And we're right there. I mean, I do believe we are right there, because these short positions that these banks have, they're losing hundreds of millions of dollars or billions of dollars in the case of Bank of America, according to Ed Steer, every dollar that the price goes up. So, yeah, it's a high-stakes game, and they have some real challengers right now.
So to your point there, let's say one of those big 8 banks breaks ranks and covers their shorts. They have to step into the market and do a ton of buying to cover those shorts, right?
Correct, which then pushes up the price and everyone else starts to cover or gets margin called. Right. That's exactly how it would happen. That's kind of what happened with the London gold pool, that break ranks and then everyone fends for themselves. There was a coordinated effort by all of the Western institutions to do this for a very long time. You listen to a guy like Tom Luongo, and it gets very interesting when you hear his take that, the rumor that Trump is out to get the European aristocrats. And in fact, there was a really interesting article that just came out the other day, and I think it was on Zero Hedge, basically saying that is the case. That's why when President Trump announced the Epstein files would be released, he specifically targeted J.P. Morgan in his speech on this, on his tweet or whatever, saying, they're involved. Well, the article went on to say that what he's doing is akin to what Kennedy tried to do. By issuing the stablecoin bill, you're taking money creation away from the Federal Reserve and giving it back to the Treasury. Very
Right.
scary. And at the same time, JP Morgan represents the old aristocrat money. And that's why he's going. Now, that's kind of fits what Tom Luongo is saying. He's saying that Trump believes that these entities were involved in any potential election interference in the previous election and or the color revolution, all aimed at Trump. And that's why he said, no, it's about tariffs, bring all the metal back, when it never was about tariffs, to drain the LBMA, to put stress or worse on the Bank of England and all the European banks that are now wickedly short in London. Whereas all the metal that came back, maybe a lot of it was used to cover the actual short positions of the United States banks that are short. When they short in the US, they go long in London, right? That's how they do it, and to offset their balance sheets. So Trump's, threatening tariffs, they're still on the same side, going back and forth. Yeah, we need that metal back to cover these positions, but don't worry, it'll flow back. It's not flowing back. Some did, but it's not. The point of it is that this is deeper than I think we all know, but there are some people like Luongo who has a very interesting take on this, that this is about United States versus the old money, and Trump is trying to undermine them. And when you see him issue the stablecoin bill, which in essence allows the Treasury through the stablecoin issuance to take control of the money, that doesn't make the old money very happy. So could it be? Maybe. I'm just saying, you got to kind of think of it all. And it does make sense on some levels, not to go down that rabbit hole, but interesting thought experiment. In London, it's believed to be between 400 and 500 to 1. Number of contracts issued versus bars available. And you can look at right now, there's 45 million ounce free float. Say there's 700 million ounces in the LBMA, in the London market, of which over 500 of it, 550, belong to the ETFs, largely SLV. So that leaves about 140, 150 million ounces that is supposedly called the float, which is debatable as well based upon what's happened recently. But if we take it at face value, there's 2 billion ounces in contracts out there that could stand for delivery against 140 to 150 million ounces there. Doesn't add up at all. And so the rumor has been between 300 and 400 paper contracts for every 1 ounce, but who really knows? A lot. I remember talking to Keith Newmeyer, who I consider a friend. And I remember having dinner with him and talking a year or two ago about this. And he said he had just come back from a conference. This probably would have been a year and a half ago. And for the first time in his career, there were industrial business owners or representatives of said industrial companies that were coming to the conferences he was speaking at, specifically to talk with him, to disintermediate the marketplace. And like I said, Tether, to your point, yes, because Tether, we've talked about the stablecoin bill, and the stablecoins will be backed by treasuries. The treasury interest is not transferable. Tether keeps it. What are they buying? Gold. And they're going directly they were at the Beaver Creek Mining Summit. They're going right to the miners and saying, we want to get gold right from you, right from the source.
Yeah.
So the answer is yes.
And they don't even need it commercially the way that like a Samsung.
Correct. But but this is the battle between investors and industrials, and it will heat up because one needs it. And the thing about the industrials, or the producers rather, who need it for making their product, is that silver is what's called inelastic.
The December 2025 silver explosion is not driven by hype. It's driven by fundamentals that have been tightening for years. Let's break down the forces reshaping the market. First, silver's price is being propelled by real monetary conditions. Reuters reports that traders are heavily pricing in a Federal Reserve rate cut for early 2026 as inflation lingers and economic momentum slows. A softer dollar and lower real yields are classic catalysts for higher gold and silver prices. This backdrop alone supports strength, but it's only the beginning. Second, industrial demand has entered a powerful, unavoidable growth cycle. According to verified global data, Silver consumption in electronics, solar panels, and electrical equipment continues rising at double-digit rates. The surge in renewable energy infrastructure, especially solar, is pulling unprecedented amounts of silver into long-term industrial use. Because silver is required in such small but essential quantities, manufacturers must buy it no matter the price. This inelastic demand makes industrial buyers the most relentless force in the market. Third, global supply is scraping against its natural limits. Silver's mine output cannot quickly expand because most silver is produced as a secondary metal during copper, zinc, and lead mining. Even with silver at multi-decade highs, miners cannot immediately boost production. Reuters confirms that global supply remains constrained while demand grows, creating a structural deficit that deepens every year. This is not a temporary shortfall. It is a persistent imbalance. Fourth, the physical versus paper market gap is being exposed. Across multiple Comex vaults, registered silver inventories sit at multi-year lows, and delivery volumes remain elevated. More physical metal is being withdrawn than deposited. This tightening inventory reduces the cushion that the futures market relies on and increases the sensitivity of prices to physical demand. At the same time, more institutions and industrial users are bypassing futures and securing metal directly, a shift from just-in-time to secure the stockpile. That behavior signals strategic concern. Fifth, geopolitical and central bank behavior is reinforcing silver's strength. While central banks primarily accumulate gold, their broader move away from reliance on U.S. dollars and toward hard assets adds indirect pressure to silver markets. Countries expanding clean energy infrastructure and technology manufacturing are increasing their demand for metals like silver, not for speculation, but for national strategy. In a world becoming more multipolar, metals with industrial and monetary value become strategic. All of this aligns with the message Andy Schectman has repeatedly emphasized for years. Gold and silver remain deeply undervalued relative to global debt, fiat expansion, and the scale of financial leverage behind the modern economy. The pricing system built on futures, derivatives, and paper liquidity is now dealing with real physical constraints. In Schectman's view, this is exactly what happens when financial markets push an asset below its natural economic value for too long. The correction becomes violent. When structural deficits meet rising industrial demand, tightening inventories, and monetary policy shifts, the end result isn't a short-term spike, it's a long-term revaluation. December 2025 is not the top of the curve. It's the opening act of a new phase in the precious metals cycle.
In this phone, there might be, I don't know, just a few bucks worth of silver, but how many phones do they make? And if the price of silver triples, what will that do to this? Well, okay, it makes it go up 20 bucks. Who cares? They pass it on to you.
Right.
These phones have gone up a lot. If you remember what the first ones were, now they're 1,500 bucks for a brand new one or whatever. So the price is going up. But if you need a 20th of an ounce, I don't know how much is in an iPhone, but if that's what you need to make an iPhone, you don't care what the price of silver is. What you do care is getting it so that you can make the iPhone.
Right.
And that's the same thing in any for the most part, in any product. The amount of silver is tiny, but it's massively needed. But because of its tiny use per unit, it's what's called inelastic. It's not a very big price component, but it is a necessity. So yeah, they will have to do that. And I think you'll probably end up seeing that because, look, since October, we've seen pretty darn close to 90 million ounces leave the Comex market. And so there's been a lot more bought that stays inside of Comex, but a lot of it is leaving. And maybe some of that metal would be Samsung or Tesla or Sony or whatever, and just taking possession of it, taking it out of the market. But a lot of it could be left in the Comex market because these big institutional manufacturers, they don't look at the system as being rigged yet, and they have no problem leaving 50 million ounces of silver inside of a Comex vault. So inside, like for example, just so people understand Comex, we have 9 Brinks facilities. One of them is a Comex facility. It's Brinks JFK. And I have people that have in our storage program huge amounts of metal in Brinks JFK, even in the form of 1,000-ounce bars. That's in the eligible account. Mm-hmm. Eligible means yes, they're eligible to be sold if they're moved to the registered account. So they're not for sale right now, and it's in a Comex facility. So if Sony had an account in a Comex facility, they could take possession of 50 million ounces of silver and leave it there because they don't see any need to store it somewhere else. And as they need it, they would have it delivered. So a lot to think about, not just the metal being purchased and leaving the facilities, but some of them would leave it there thinking there's no reason to worry about it, right? So anyways, yeah, I think that is something that we can expect to see more and more of as the price goes higher. The necessity to secure future production of your product would say we need to get it and we need to get it now, and I think you'll see that happen. And not only that, at the same time, China says we're going to limit exports, and the U.S. says it's now a critical mineral, and so it's progressing. It's progressing, and with that, the price is going higher. And with that, you shut down the Comex because of a server overheating. Because now the rumor was, and I don't even know how the hell this rumor gets any validation. I don't know. The rumor on X is that 400 million ounces were requesting delivery. Now, there's not even that's way more than there's on in the registered category. Not sure where that rumor is coming from. One big Asian trader said, I want 400 million ounces. All I can tell you is this, that these rumors, a lot of them lack substantiation, and a lot of them may be just, just that, a rumor. But I think where there's smoke, there's fire. And the way that I would break it down is that at that level, you're seeing shortages and strain in the system, and rehypothecation in London will be the death of them. And it's true. Big money is I think for the first time understanding that physical possession is the way to go. Getting it off of the exchanges, taking possession, buying it, and standing for delivery. This is what's different about this market. Nobody stood for delivery my whole career, and now
Right.
you're seeing it every single month. And I guess the exclamation point to me is that the amount of metal coming into Comex every single month, it's different when I say the central banks around the world. People kind of lacks it lacks the oomph because it's not happening here. When I tell you it's 4 feet of snow in Death Valley in July, what's happening on Comex right now, we've never seen these kind of deliveries, and the lack of any questioning it, by any of the mainstream. It's crazy to me, unless it's all by design, because it's very, very, very unusual, and it should be front and center news. Because what does it really mean when you're seeing this kind of volume of gold and silver, the antithesis to the dollar? What does it really mean when the biggest money in the United States is doing that, and no one's asking who it is?
Right.
To me, it means a lot.
Colin here, sorry, not there. Vander Clippers says here, in an iPhone, there's around 1/60th an ounce of silver. I don't know if that's true or not. I'll take him on face value here. But, how many millions of iPhones does Apple, produce each year? Well, divide that by 60, and that's how many ounces of silver you need, right?
Yeah, and then add in Samsung and everything. Anything that conducts electricity or has a motherboard primarily has silver in it.
Right. And presumably what, Tesla, in addition to all its cars, is going to be building 1 million robots pretty soon. Pretty sure there's going to be a fair amount of silver in those robots.
Correct. Absolutely. And that's why there'll be a battle at some point between and that's the thing.
The signals are impossible to ignore. Silver is tightening across every level, from industrial offtake to sovereign strategy to physical inventories. Gold is holding near historic highs, monetary policy is shifting, and the financial system is entering a period where real assets matter more than ever. If you want to stay ahead of this transition, the delivery flows, the inventory trends, the monetary shifts, and the deeper structural changes, make sure you're here for the next update. This story is accelerating fast, and the next phase may reshape how investors, institutions, and even governments view precious metals. Before we wrap up, I want to hear from you. Do you think this December surge is the start of a long-term global revaluation of silver and gold, or is the real shock still ahead of us? Share your thoughts. Your perspective might shape the next deep dive.